Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio Strategy and Management. This presentation is about monetary trends, and quite frankly, they are very, very interesting, and there is a lot of money to be made between you and I. Now, my approach to the markets is based on my experience, which is I managed 3 billions of interest rates, derivatives, and 1 billion of currency. But in my experience, I found that business decisions is what really drives the markets. Business reacts to what happens and what the government and the Fed does, but eventually their decisions act on the markets. Let me show you how. I'm going to discuss now very briefly my concept of the business cycle. And once you recognize where we are in the business cycle and how long it lasts in the current phase, you will see that you have all the time to plan your investment strategy. Not only that, but you are able to recognize what are the monetary trends, at least for the next 12 months. Let me show you. The business cycle goes through 4 phases. This is the beginning of the expansion. Then here there is strong growth. At this point, there is inflation, interest rates start rising. Here business becomes more defensive. They recognize they have too much inventories. They start cutting production, reducing the growth. And if phase 4 is the critical one, this is where we are in. This is the phase where business recognizes has too much inventory, they have to cut it. So what do? You cut production. What else you can do? Well, you have to cut prices because you have to reduce inventories. You start borrowing less because now you need less plant capacity. But by borrowing less, of course, there is a downward downward pressure on interest rates. Then, of course, you're hiring less people. First, you extend working hours, and then you start hiring fewer people. Actually, start laying off people. So all what this phase is purpose of this phase is really to resolve all the issues that have been raised, the problems that have been appearing on phase 3. We are in phase 4. Why? Because exactly what I just told you, everything is being corrected. It has to go down. Only when inventories and interest rates and everything are at low levels, and I'll show you where, then finally what business will do. Okay, let's start producing again, hiring, borrowing, and so the business cycle start going again. By the way, this is also where, of course, in phase 4 is that business needs to cut production, so obviously it reduces the purchases of raw materials. So you see downward pressures on commodities from copper to crude oil to everything. So let's see now what the data are saying from a monetary viewpoint. Monetary and financial data are really the major leading indicator of the business cycle. And government spending, this is government spending, is what really has been causing the major volatility of this business cycle. This is growth in government spending because of COVID. And then what you see is a tremendous slowdown in government spending. Notice the government spending roughly peaked in 2021. Let's say if you average out is around this time, okay, 21. So let's see now what is happening next. What is an interesting development is this increase in government spending that is happening Q1 22. This is very interesting, but again, the lead of this data is so long that this will have an effect maybe in at the end of 24, maybe 25. So let's see what happens because of the increase in government spending, what has happened to the financial markets and where the financial markets are likely to go because of this downtrend. Now, when the government gives money to the people, obviously, what do you do when you get the money? You put it in the bank. That's the most important thing. It is money that is readily available. It goes into the banking system and has immediately an effect on the economy. So this is what happened to the money that the government gave us. We put it in the banks. So deposit in the banks rose tremendously. What that means that the banks were flushed with cash, ready to be spent by us. But then, as I said before, the government now slowed down since 2021, 2020, the end of 2020, slowed down the printing press. They gave less money to the people. So what happened to the bank deposits? Look what happens. Big slowdown, and now we have a contraction. In other words, now banks don't have the growth in deposit is much slower and declining. Now, why is this important? Because banks are the ones that print money, not the Fed. Why? Because the banks take all this money that we give them, and then they relend it. And so that money is redeposited in other banks. And so there is a multiplier effect. But with now deposit slowing down, also the availability of liquidity in the economy is also slowing down dramatically. In fact, here, what that means that deposits are declining, meaning what? Meaning that there is less money to lend and less money to available for purchases. Now, notice again that the peak in the growth in bank deposit, this is a very important date, around 2021, in the mid-2021. So what we have seen so far is that the government gave money to the people to spend. People put the money in the banks, and bank deposits first increased, and now since 2021 they slow down because the government is not giving as fast money as they used to. So now what happens? That the money supply, the liquidity in the system, in the economy is slowing down. Now, why do we care? We care because this peak, this is a very important leading indicator. This peak in money supply leads the economy, that is, let's say the growth in production, by roughly 1 year. And then leads the inflation by a year and a half to 2 years. So what this curve is saying is already saying what will happen in the next year and a half. It's already set in stone, that you believe it or not. So the current news don't matter, because already the next 2 years already have been set up. You don't believe me? Well, you should follow my other videos that I wrote on the subject. So, but what I'm saying is the money supply slowing down means that the economy is going to, so peaked in 2021, so the economy should start slowing down in 2022, 23, and in fact, that's exactly what is happening. How do we know? Let's see the next data. The decline, the slowdown and contraction in the money supply is causing the economy to slow down. So what business does? Business slows down production, slows down employment, slows down borrowing. And you can see that they are slowing down the accumulation of inventories because commodities have been slowing down. You see, from beginning 2022, the money here peaked in 2021, somewhere in here, the money supply. And then after a year, production started slowing down, and with it, commodities. So commodities are slowing down because of the weakness in liquidity, which will continue at least for another year. Why? Because the money supply will have to increase at least for a year before you see production picking up and then eventually commodities to rise. So we are really in a downtrend in commodities, as is driven by the continued weakness of the money supply. As I said, history has been set by the decline, the slowdown of the money supply between 21 and 22. So what we are seeing now is the effect of that slowdown, which will last at least for another year. So we have seen the government slowing down, the giving money to the people, fewer deposits in the banks, money supply slowing down, business after a year lag started slowing down. They're cutting inventories, therefore they're buying fewer commodities, so commodities are going down. And then, of course, business, what do? They also borrow less money. They need less capital to finance production, employment, and purchasing. So if I told you before, the money supply peaked somewhere in here, the slowdown. And then after a year, what you see now after the slowdown in the economy, you see commodities peaking and you see commodities declining. So how far will the decline in interest rates will last or will go? Well, at least for another year, because it takes a year and a half for the money supply to grow, to get the economy going again, and then for business to buy raw materials, to borrow, and so on. So this trend, interest rates have peaked and are likely to go down. And again, it's not a matter of the Fed easing or not easing, it's the fact that business is buying fewer raw materials and borrowing less because they have to cut inventories. Besides, demand is slowing because of higher inflation. So the lack of liquidity, the decline in liquidity is forcing business to slow down the operations because there is less liquidity around, people are buying less, so they're cutting production, and by cutting production, of course, they reduce prices, they have to buy fewer commodities, and of course, they borrow less to improve capacity or to improve machinery, meaning that with the decline in commodities, one sees also a decline in interest rates. And the outcome as the interest rates decline, this is TLT, which is invest in long-term treasuries. As interest rates decline, TLT is going to appreciate, and this is the beginning of a major bull market. But there is something else too that is important, and this is the price of gold. Gold is very closely related to interest rates. If interest rates decline, gold prices rise. And when interest rates rise, gold prices decline. So what happens here when interest rates start coming down and bond prices rise, what you should see also the price of gold appreciating, which is exactly what is happening. So as long as interest rates decline and commodities decline, which is a trend that is going to last for quite a bit of many months, these two trends here, this in TLT and gold, should continue. We have seen that the slowdown in liquidity is causing business to slow down. They're cutting production, they're cutting raw materials, so commodities are coming down, they're cutting borrowing, so interest rates are coming down. But also when all this liquidity is reduced, then also credit risk increases, because now the companies that have less liquidity, they may get in trouble. And this can be shown in the increase in the spread between safe bond yields and low-grade bond yields. And this is what this spread shows, is the spread between high grade and low grade. And the red line is the stock market. What you see is that when the spread, that is the risk, goes above the green line, is a period of consolidations and weakness in the stock market until credit risk peaks and starts slowing down. So what this credit risk is talking about, what this spread is saying, is that as long as we are above these green lines, or actually as it remains above this green line, then the market is in trouble. So the point is, risk is high, so caution is mandatory, which is typical of phase 4. Now, from what I said before, phase 4 could last anywhere between 1 to 2, even 3 years in this case, given that the money supply is still contracting. So it takes another year and a half. Even if it starts going up now, it will take a year and a half for the economy to improve. Again, we'll keep track of this data, and we'll see what happens. As you know, I am the editor of the Peter Dack Portfolio Strategy Management. If you go to this website, you can enter a free subscription and There is no credit card requirement, none of that. But you can see what my work, what I've been saying, which basically I've been saying almost, the trend. I nailed the trend beginning in 2021. I wrote this book, was commissioned by McGraw-Hill, and the objective here is to see how business cycles impact the financial markets. I also wrote these two books. One, this is a study on how the markets and moving averages, how interact with each other, and what is the best way to use moving averages. This is a recap of all what I said before. And of course, all my articles you can see on peterdac.com. You can also follow me on YouTube at George Dagnino 5017. These are all where my videos are stored, and you can review them. So you can see if what I'm saying is as a track record, I guess. That's what I'm saying. Well, I thank you very much. Until next time, be well. Take care of yourself. So long.